32 out of $50. That's the price level silver just crossed, and if you don't understand what that means, you need to listen very carefully to what I'm about to tell you. Because this isn't just another technical breakout. This is the exact threshold that's triggered 4 of the largest precious metals explosions in modern history. And every single time silver decisively broke through this level, what followed was a minimum 150% gain in less than 12 months. Not similar moves, identical patterns, same timeline, same devastating outcome for anyone who wasn't positioned. The clock started 14 days ago when silver closed above 30 Tau 50 for 3 consecutive sessions. And while you were watching the stock market hit new highs and listening to analysts talk about soft landings, the largest institutional players in the world started doing something they haven't done since 2010. They're accumulating physical silver, massive tonnage, quietly, systematically, without headlines. Central banks that haven't touched silver in decades are buying. Billionaire family offices are taking delivery. Mining company insiders are loading up on their own stock. This isn't speculation. This is documented flow data, exchange warehouse receipts, SEC filings, numbers you can verify yourself. By the end of this video, you'll understand exactly why $30.50 is the line that separates consolidation from explosion. You'll see the mathematical pattern that's repeated 4 times since 1970. Same technical setup, same institutional behavior, same parabolic acceleration phase. And most importantly, you'll know exactly where we are in the cycle, right now, today. Because there's a timeline here, a historical timeline that's played out with remarkable precision every single time. Stage 1, accumulation, 12 to 24 months. Stage 2, breakout and recognition, 60 to 90 days. Stage 3, parabolic acceleration, 90 to 180 days. We just entered stage 2 14 days ago. The only question is whether you'll position yourself now while we're still in the early innings, or whether you'll be chasing prices 200% higher in 4 months, asking yourself how you missed all the signs. Stick with me, because the next 18 minutes will show you a pattern so clear, so mathematically precise, that you'll never look at silver the same way again. This has happened 4 times in 150 years. Same stages, same warning signs, same explosive outcome. And it's happening again, right now, in real time. So why 32.50? What makes this specific level different from every other resistance point silver has tested over the last 3 years? Let me show you exactly why this number matters, and why institutions have been waiting for this exact breakout. $32.50 represents a convergence of 3 critical factors that only align once every decade. First, it's the 61.8% Fibonacci retracement level from silver's 2011 peak at $49 down to the 2020 low at $11.70. If you don't trade technical analysis, don't worry about the math. Just understand this. The 61.8% level is where institutional algorithms are programmed to recognize trend reversal. It's the line in the sand that separates corrective moves from new bull markets. Every major silver bull run in the last 50 years confirmed when price broke and held above the 61.8% retracement of the previous decline. Second, 32.50 is the average cost basis for the largest silver ETF accumulation that happened between late 2023 and mid-2024. Over 87 million ounces flowed into SLV and PSLV during that window. The institutions that accumulated those positions, they weren't buying for 10% gains. They were positioning for the breakout. And breakouts don't confirm until price moves above the accumulation zone. That zone tops out at $32.50. Third, and this is the one that matters most, $32.50 is the inflation-adjusted equivalent of the 1979 breakout level that triggered the move to $50. When silver broke through $10 in January 1979, that level represented the same percentage above the 10-year moving average that $32.50 represents today. Same mathematical relationship to trend, same position in the accumulation distribution cycle, same setup. On November 29th, silver closed at $32.63. December 1st, $32.87. December 4th, $32.91. 3 consecutive closes above the level. That's not noise, that's confirmation. And here's what nobody's talking about. The volume on those 3 days was 340% above the 90-day average. Volume doesn't spike like that on random moves. Volume spikes when institutions execute size, when algorithms trigger buy programs, when the smart money that's been waiting finally commits capital. The level held, the volume confirmed, the clock started. Now let me show you what happened the last 4 times this exact setup played out, because the pattern doesn't lie and history doesn't forget. Every major silver bull market since 1970 has followed a precise 4-stage cycle. Not similar cycles, identical structure, same timeline, same psychological progression. And if you understand these stages, you can position yourself in stage 2 and capture the entire move before the public even knows what's happening. Let me walk you through the framework, then I'll prove it with 4 historical examples spanning 50 years. Stage 1, accumulation and consolidation. Silver trades in a range, usually for 18 to 36 months. Price looks dead. Momentum traders lose interest. Retail investors sell out of boredom or frustration. But during this phase, something's happening beneath the surface. Institutional players, the ones who read balance sheets and understand monetary cycles, they're accumulating quietly. ETF holdings increase. Warehouse inventories decline. Mining company insiders buy stock. The smart money builds positions while nobody's watching. And this stage typically lasts 18 to 36 months depending on the macro backdrop. Stage 2, breakout and recognition. Silver decisively breaks above the key technical level. Could be a Fibonacci retracement, could be a multi-year resistance, doesn't matter. What matters is the break holds. 3 to 5 consecutive closes above the level with expanding volume. That's confirmation. Once confirmed, institutions that were accumulating in stage 1 now add aggressively. Momentum algorithms trigger. Technical traders recognize the trend change. Stage 2 typically lasts 60 to 90 days. Gains during this phase, 40 to 70%. Not enough to make headlines, but enough to get attention. Stage 3, parabolic acceleration. This is where fortunes are made and lost. The breakout from stage 2 attracts media coverage. Analysts upgrade silver. Retail investors who missed stage 1 and 2 start buying. Fear of missing out kicks in. Price moves become vertical. 5% days, 8% days, gaps higher on opening. The move that took 24 months in stage 1 happens again in 90 days during stage 3. Typical stage 3 duration, 90 to 180 days. Typical gains from stage 2 entry, 150 to 400%. Stage 4, exhaustion and correction. Euphoria peaks. Everyone's talking about silver. Taxi drivers are giving trading tips. Then reality hits, profit-taking accelerates. Momentum breaks. Sharp correction follows, usually 40 to 60% from the peak. The cycle resets. Same 4 stages every single time. Same progression, same timeline, same result. Now let me prove this pattern is real. 1974 to 1978, stage 1. Silver consolidating between $4 and $6 per ounce. The public wasn't paying attention. Gold got the headlines. But behind the scenes, major players were accumulating. The Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, started buying physical silver in 1973. Not small positions, hundreds of millions of ounces. Why? They understood what was coming. Nixon had closed the gold window in 1971. The dollar was pure fiat for the first time in history. Inflation was running at 12%. The smart money knew paper currency was getting destroyed and hard assets were the only shelter. By 1978, silver had consolidated for 4 years. Most investors had forgotten it existed. Stage 1 complete. January 1979, the level breaks. Silver pushes through $10 per ounce and holds. That was the technical threshold, the 61.8% retracement from the previous cycle high. 3 consecutive weekly closes above $10 with volume, running 400% above average. Stage 2 confirmation. Over the next 8 months, silver climbs from $10 to $21, a clean, steady move. No parabolic blow-off, just consistent higher highs and higher lows. Institutions that missed the accumulation phase at $5 are now buying at $12, at $15, at $18. They see the trend. They see the fundamentals. Inflation's accelerating, the Fed's trapped, they're adding exposure. By September 1979, silver sits at $21, stage 2 complete, then the acceleration hits. October 1979 to January 1980, stage 3, the parabolic phase, silver goes from $21 to $50 in 4 months. That's 138% in 120 days. The mainstream media finally notices. Time magazine runs cover stories. Coin dealers can't keep inventory. Lines around the block to buy silver bars. Everyone who ignored it at $6, who hesitated at $12, who waited for a pullback at $18, they're all buying now at $35, at $40, at $48. Pure fear of missing out. The Hunt brothers kept accumulating even at elevated prices, taking delivery of physical, squeezing the futures market. January 17th, 1980, silver hits $49.45 intraday. The peak, stage 3 complete. February 1980, stage 4. The correction, silver drops from $50 to $30 in 3 weeks, then to $10 by March. Brutal, fast, devastating for anyone who bought the top. But here's what matters. Anyone who entered at the stage 2 breakout, who bought when silver crossed $10 in January 1979, they still made over 400% at the peak. Even selling halfway down the correction, they doubled their money. The pattern worked. Same 4 stages. Now watch it happen again. 2003 to 2005, stage 1. Silver's trading in a tight range between $4.50 and $6. The dot-com bubble had burst. Stocks had crashed. The Fed was cutting rates aggressively. Money printing had started, but nobody was talking about inflation yet. Silver looked dead. It had been in a 20-year bear market since the 1980 collapse. Most investors wanted nothing to do with it, but the fundamentals were shifting. Industrial demand was increasing. Solar panel production was ramping up. Electronics manufacturing in Asia was exploding, and above-ground inventories that had suppressed prices for decades were finally being depleted. The smart money saw it. Warren Buffett had accumulated 130 million ounces between 1997 and 2006. George Soros was building positions. Jim Rogers was publicly telling anyone who would listen that commodities were entering a supercycle. They were accumulating while silver sat ignored at $5. Stage 1 accumulation verified. Late 2005, the breakout happens. Silver pushes through $8 per ounce in September and doesn't look back. 3 consecutive monthly closes above $8. Volume confirmation, the algo triggers fire, institutional buying accelerates. Over the next 12 months, silver climbs from $8 to $13.50. A 68% move, steady and controlled. No blow off top, just a persistent grinding higher. The technical breakout attracted momentum traders. The fundamental story attracted value investors. Mining stocks started outperforming. Analysts who had ignored silver for years started publishing research. Media coverage increased. By late 2006, silver's at $13.50. Stage 2 complete. The recognition phase had done its job. Now the real move begins. 2007 to March 2008, stage 3. The parabolic acceleration. Silver explodes from $13 to $21 in 10 months. That's a 162% gain. The financial crisis was building in the background. Subprime mortgage issues were surfacing. Bear Stearns would collapse in March 2008. The Fed was cutting rates. Inflation fears were spreading. Silver became the trade. Retail investors who sat out stage 1 and 2 were now piling in. Coin sales at the U.S. Mint hit record levels. Silver ETFs saw massive inflows. SLV, the largest silver ETF, launched in 2006 and grew to over 200 million ounces by early 2008. Everyone wanted exposure. The move went vertical in the final 90 days. March 2008, silver peaks at $21. Stage 3 complete. Then the financial crisis hits full force. And Lehman Brothers collapses in September 2008. Liquidity disappears. Everything sells off. Silver crashes from $21 to $9 in 6 months. Stage 4 correction, brutal and fast. But the buyers at the $8 breakout level in 2005, they still made over 150% at the peak. The pattern held again. Same stages, different decade, same result. 2008 to mid-2010, stage 1. Silver's recovering from the financial crisis collapse, consolidating between $12 and $18. The world's still reeling from the Lehman Brothers collapse. Central banks are printing money at unprecedented levels. QE1 launched in late 2008 and $1.7 trillion pumped into the financial system. The Fed's balance sheet exploded. But most investors were still traumatized, still in cash, still afraid to take risk. Silver sat quietly in its range while the smart money accumulated. Mining companies were buying back stock. Billionaires like Eric Sprott were launching silver funds and taking physical delivery. Central banks in emerging markets were diversifying reserves. The setup was building, but the public wasn't paying attention yet. Stage 1, 24 months of quiet accumulation while everyone else was paralyzed by fear. July 2010, the breakout. Silver decisively breaks through 1850 and holds. 4 consecutive weekly closes above the level. Volume spikes to 420% of the 90-day average. The technical break was clean, undeniable. Stage 2 begins. Over the next 4 months, silver climbs from $18.50 to $25, a 35% move that gets zero mainstream attention. Stocks are rallying, real estate is bottoming, nobody cares about silver at $20, but the institutions care. SLV holdings increased by 41 million ounces in Q3 2010 alone. The U.S. Mint reports record Silver Eagle sales. Sprott Physical Silver Trust launches and immediately sells out. November 2010, the Fed announces QE2, another $600 billion of money printing. The currency debasement trade is on. By December, silver's at $29, stage 2 complete. The recognition phase attracted the early movers. Now the real explosion starts. January to April 2011, stage 3. Silver goes parabolic, $29 to $49 in 4 months. That's a 169% move in 120 days. The media finally catches on. CNBC runs silver segments daily. Bloomberg covers it. Coin dealers are sold out nationwide. The Hunt Brothers comparisons start flying. Everyone who missed $12, who hesitated at $18, who waited at $25, they're all buying now at $40, at $45, at $48. Pure momentum, pure FOMO. April 28th, 2011. Silver hits $49.82 intraday. Almost the exact same peak as 1980. Stage 3 complete. May 2011, the correction. Silver drops from $49 to $33 in 2 weeks, then grinds down to $26 by September. A 47% collapse in 4 months. Stage 4, devastation for late buyers. But anyone who entered at the 1850 breakout in July 2010, they still made 169% at the peak. Even selling halfway down, they nearly doubled their money. 3 historical examples, 3 cycles, same pattern every time. Now let me show you why it's happening again.